Are you self-employed or a small business? Chances are you're paying a lot in taxes. Now, what if I told you that there's a simple strategy in which you can take a solo 401k plan and put it inside of a S-corporation structure and make this beautiful thing which will save you thousands in taxes, will boost your retirement savings, and will save you a whole lot of money. And stick around because I'll also show you 2 additional strategies which can help you really maximize all of the tax buckets inside your solo 401k plans. And don't you worry, I'm going to use a case scenario to really break it down for you guys. Hi, and welcome to the Money Matters MD show. I'm your host, Dr. Abhishek Gadre. I'm a pulmonary and critical care physician, and I absolutely love to talk about personal finance topics and make them super easy to understand. So let's jump in to talk about the solo 401k plan and S-corporation and how they work together beautifully. So first, let's talk about a solo 401k plan. A solo 401k plan is basically exactly the same as your big employer regular 401k plan, except you are the employee and you're also the employer. Now, solo 401k plan is just like playing a tic-tac-toe game using a 3x3 grid. You got 3 columns, which are 3 different tax buckets, and you got 3 different rows, which are the inflow methods to put money in these tax buckets. And I have a whole separate video discussing 401k plans, and I highly recommend you go watch it because the base concepts are exactly the same between solo 401k plans and the traditional 401k plans. So you basically have a pre-tax bucket in which money goes in before paying any taxes on it, and you'll owe taxes on this money in the future. Think of this bucket as a joint account between you and Uncle Sam, which is the IRS, and you don't really know what your future tax bracket is going to be. The second tax bucket in the middle is the Roth 401k bucket, in which money goes after tax, and all the money will grow tax-free for the rest of your life. The third tax bucket is a more rare tax bucket, which is called the after-tax bucket, and most traditional 401k plans don't offer this bucket. But this particular after-tax bucket gives you the ability to access a very powerful retirement strategy called the Mega Backdoor Roth 401k strategy. Now you also have 3 inflow streams, the first one being the employee contribution, which is the traditional W-2 payroll contribution, in which you yourself as the employee will put money in via the payroll. The second type of contribution is the employer contribution. And again, remember, you are also the employer, so your S-corporation on your behalf will put money in to your employee's 401k plan, and that's called the profit sharing plan. The last type of contribution is the employee after-tax contribution. And this type of contribution is a voluntary contribution by the employee into an after-tax bucket, which is a special bucket. And once money gets in there, you can roll over money from the after-tax bucket into the Roth 401k bucket. And this type of strategy is called the Mega Backdoor Roth 401k strategy. And this really helps you turbocharge your Roth 401k contributions, and all the money contributed will be tax-free forever. Now, I'm going to put up on the screen the 2025 IRS maximum for the different tax buckets and the different income streams. So as a W-2 payroll, as of 2025, you can contribute up to $23,500. The profit sharing plan is limited up to 25% of your W-2 payroll, and it can go as high as to the IRS maximum limit of $70,000. In no way you can contribute more than $70,000. That's where IRS caps the 401k plan for everybody under age 49 and less. Now, there are catch-up contributions allowed for age 50 and higher. I recommend you screenshot this and save this for future use. I'll update this every single year so that you have access to the latest numbers. Now, let's talk about the different types of 401k plans itself. So now, as you as an S-corporation owner goes and tries to open your own solo 401k plan, you'll probably go to a large brokerage firm like Charles Schwab or Fidelity, and the standard solo 401k plan or self-employed 401k plan or individual 401k plan, they're all pretty much the same, offered by these big brokerage firms, offers a pre-tax bucket, and some of them offer a Roth 401k bucket, but none of them offer the special after-tax bucket. So you're not going to have access to the mega backdoor Roth 401k strategy by going to a big brokerage firm. Now, the second type of solo 401k plan is called a custom solo 401k plan. This is administered by private companies like mysolo401k.net, which is my recommendation. I personally use their solo 401k plan, and this is not a sponsored video. If you are a DIY investor, this is the best way to turbocharge your retirement plan and having access to that after-tax bucket so that you can utilize the mega backdoor Roth 401k strategy. Hey, so I know the solo 401k plan is a little bit complicated, and in the upcoming slides, I'm going to show you a lot of numbers and how the cash flows through an S-Corp operation, and it can be a bit complicated and overwhelming. Don't you worry, I have 3 tips for you to get through this easily. Tip number 1, I just want you to pause in those cash flow charts and review the numbers and understand how the cash flows through the system and how you're able to save. And if you need, you can pause and rewind it a little bit and try to plug your own numbers in and see how it will work for you. Tip number 2, I want you to know how the basics of an S-Corporation cash flow plan works. If you need to brush up on that, you can go back to my video in which I discuss S-Corporation versus LLC cash flow models. And I think that'll be really straightforward for you moving forward. Tip 3, I want you to know the basic bells and whistles of a regular 401k plan before you jump in to try to understand a solo 401k plan, and have a whole separate video on a regular 401k plan, and that might be helpful for you to watch in advance a bit as well. Now let's review the S-Corp cash flow strategy. I have a whole separate video on the S-Corp cash flow strategy versus LLC versus sole proprietorship, which I'd highly recommend you go see if you're not familiar with that concept. But let's see how cash flow works in an S-Corp structure. So the income flows into the business bank account of your S-Corporation, and you're allowed to deduct any business expenses. So the IRS defines this as any ordinary and necessary expenses for your business are allowed to be deducted as a business expense. So you divide the profits basically into 2 parts. You have access to one part as an employee, and you have access to the second part as the employer. The employee accesses this money via a W-2 payroll, and as an employer, you access the profits as a K-1 shareholder distribution. Now let's talk about a case scenario. We're going to talk about Dr. Smith, who's a hospitalist, and he works as a locum tenens doctor, and he makes income as a 1099 physician and puts money into his S-Corporation. The YouTube analytics tell me that a lot of you viewers are not actually my subscribers right now. If you would like to support my channel, please hit that subscribe button and like and share my video. Let's say he makes around $330,000 a year and he spends around $30,000 as expenses. So his net profit is around $300,000 a year. And he splits that into 2 parts. He pays himself a W-2 payroll salary of around $160,000, and he accesses the second part, around $140,000, as a K-1 shareholder distribution. Now, Dr. Smith's goal is to max out his solo 401k plan and contribute to the IRS maximum limit of $70,000 for 2025. So as an employee, Dr. Smith can contribute $23,500 via the W-2 payroll, and he gets a deduction for that when the income flows through to his personal tax returns. And as an employer, Dr. Smith Inc. can deduct around $40,000, which is up to 25% of his W-2 payroll, as a profit sharing plan contribution. Now, this particular amount is a deductible expense to the business, and it comes out before profits as an expense to the S-Corporation. Now, this effectively reduces Dr. Smith's K-1 shareholder distribution. Now, in this scenario, Dr. Smith was able to contribute around $63,500 for the given tax year, and he reduced his taxable income from $300,000 to around $236,500. Now, I wanted to keep the numbers easy to understand. That's why I didn't factor in the payroll taxes in this calculation. Now, Dr. Smith wanted to contribute to the IRS maximum, which was $70,000 for the tax year. What can he do to maximize his contribution? Because so far he's only contributed $63,500. Now, there are 2 possible strategies Dr. Smith can employ. Strategy number 1 is called W-2 payroll optimization. Now, right now, Dr. Smith is paying himself around $160,000 in W-2 payroll. If he is to increase his W-2 payroll to $186,000, he'll be able to contribute a maximum of $46,500, which increases his total 401k contribution to $70,000 max limit for 2025. If Dr. Smith's goal was to contribute the maximum amount of money in the pre-tax bucket, the W-2 payroll salary optimization is probably the best strategy to go with. Yeah, it does decrease the K1 shareholder distribution, and I know some people will say you're paying slightly more in payroll taxes, but did you see that Dr. Smith just saved $6,500 more and he'll pay less taxes overall? Now, strategy number 2 is the mega backdoor Roth 401k strategy. This is even simpler. So as an employee, Dr. Smith can put $6,500 of his own after-tax money into the after-tax tax bucket and then roll it over into the Roth 401k bucket, and therefore he contributed $70,000 and got to his goal of the maximum IRS allowable 401k contribution for the year 2025. Now, this is a good strategy if Dr. Smith wants to diversify a little bit between pre-tax and the Roth 401k buckets. Now, let me give you just a quick heads up on the different tax forms that you will need to be aware of. So once you reach a minimum of $250,000 in assets within your solo 401k plan, you will have to file a form called 5500EZ. So when time comes to file your personal tax return, that's just a form that you need to incorporate so that IRS can keep track of your solo 401k plan. Now, the second type of tax form you guys need to be aware of is a 1099-R form. This is for folks who are doing a mega backdoor Roth 401k strategy. You just have to keep track of the amount you contributed and the amount it grew by and the amount you converted. And you'll have to report all of these numbers to your retirement plan administrator so that they can issue you a 1099-R form. And again, there is no taxes owed on this type of a contribution. You just have to attach it along with your personal tax return. So here are some take-home points. With a solo 401k plan inside of an S-Corporation, you can deduct up to $70,000 a year as of tax year 2025, and this number only goes up every single year by a few $1,000s. You can slash your tax bill by tens of thousands of dollars by employing this plan, and you can accelerate on your path to financial freedom. If you're a profitable small business owner or a self-employed professional, this is not optional, this is just essential. Now, I'm going to talk about cash balance plans in one of my next videos. And if you're a high-income professional, a cash balance plan is the most high-yield plan that you can stack on top of a solo 401k plan and save and deduct more than $100,000 a year and save tens of thousands of dollars every single year. It's just a nuclear bomb when it comes to tax planning. Now, if you learned something useful today, please like and share my video and subscribe to my channel. Thank you so much for watching the Money Matters MD show. Over and out. The Money Matters MD show is for educational and entertainment purposes only. This is not financial, legal, tax, or medical advice.